I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a phenomenally successful car dealership chain. I actually used to work in the auto industry at a luxury car dealership. In fact, that was before I retired. The car dealership business model, it's a fantastic one. They lock you into an ecosystem since newer cars basically require OEM car dealerships for servicing, and those service departments, high margin money centers. That's what's helping this car dealership chain to post up incredible revenue, profit, and dividend growth. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity recently came across in shares of Lithia and Driveway, which appear to be trading at a significant discount today. Lithia and Driveway, stock ticker LAD, is an American automotive dealership group. Founded in 1946, Lithia and Driveway is now an $8 billion by market cap car dealership monster that employs more than 20,000 people. Lithia and Driveway operates approximately 300 dealerships across 25 U.S. states, representing 40 different OEM car brands such as Stellantis and Toyota. The company also started international expansion recently by entering Canada and the UK, but the vast bulk of operations are in the US. The company reports results across 5 categories: new vehicle sales, 46% of fiscal year 2022 revenue, used vehicle sales, 38%, service, body and parts, 10%, finance and insurance, 5%, and fleet and other, 1%. Because of the higher margins in servicing and providing parts for vehicles, the company's service, body, and parts category accounted for an outsized portion of fiscal year 2022 gross profit, nearly 1/3. By vehicle type, its sales mix for fiscal year 2022 was import 43%, domestic 29%, and luxury 28%. Lithia and Driveway has used the serial acquirer method to build up an empire of automotive dealerships. This is a terrific business model on which to apply such a method, as automotive dealerships have an economic flywheel built right in. Once someone buys a new or even gently used vehicle from a car dealership, they're locked into an ecosystem. Only dealerships with direct OEM relationships are authorized to carry out warranty repairs on vehicles. These repairs cannot be handled by Bob's Repair down on the corner. Moreover, because of how complex modern vehicles are, it's difficult, sometimes even impossible, for independent repair shops to handle maintenance and repairs on these vehicles without access to certain machines, documents, and specialized technicians. And that's only one way in which this plays out. There are also lease returns leading to another lease, as well as customer loyalty to brands leading back to the OEM dealership once again. Plus, dealerships run local monopolies, as OEMs tend to offer only so many franchise rights per geographic area. America runs on the automobile and the independence that an automobile confers. With a dearth of public transportation in most areas of the US, the powerful dealership model is very sticky and likely to persist for many years to come. This bodes well for the company's ability to continue growing its revenue, profit, and dividend. Already, Lithia and Driveway has increased its dividend for 14 consecutive years. The 10-year dividend growth rate stands at 14.6%. While that's an incredible rate of dividend growth, what's even more incredible is the fact that dividend growth has actually been accelerating. Indeed, the last couple of dividend raises were approximately 20% each. And since sustainable dividend growth must be powered by business growth over time, this kind of dividend growth has encouraging implications for what the business has been doing. Now, the stock only yields 0.7%. This is obviously not a yield play. Instead, it's a high-quality compounder. One sacrifices yield in order to access the high rate of compounding here, and I think that's a very acceptable trade-off, assuming one isn't already in old age and in need of immediate income. All that said, this yield is basically in line with its own 5-year average, so market participants have historically been willing to accept this lowish yield in order to tap into the growth. That's been a smart move, as the business and stock have performed wonderfully well. Notably, the payout ratio is only 5.3%, despite the huge dividend raises over the last decade. This is one of the lowest payout ratios that I know of, and it gives the company plenty of headroom to increase the dividend over the coming years, even if the business has some bumps along the way. For dividend growth investors who lean more toward growth over yield and like to compound their money at high rates over time, this company's dividend growth profile is highly alluring. Looking at business growth, Lithia and Driveway moved its revenue from $4 billion in fiscal year 2013 to $28.2 billion in fiscal year 2022. That's a compound annual growth rate of 24.2%. Very, very impressive. However, it should also be said that the company is a serial acquirer, consistently and methodically acquiring smaller dealerships in bolt-on deals in order to open up new markets and drive additional growth beyond what's organically possible. I'm a big fan of the serial acquirer model and wholeheartedly approve of its usage in a highly fragmented market like this. The company's recent announcement to acquire Pendragon's UK Motor and Fleet Management divisions through a strategic partnership for a cash consideration of approximately $350 million, which further expands Lithia and Driveway's geographic footprint, is a good example of this behavior. All of these acquisitions have a way of driving absolute top-line growth, but what about relative bottom-line growth? Well, the company increased its earnings per share from $4.05 to $44.17 over this 10-year period, which is a compound annual growth rate of 30.4%. Truly outstanding. There has clearly been value creation, not value destruction here. These acquisitions have been accretive to the parent organization to the benefit of all shareholders. This level of performance is really quite remarkable. Looking forward, CFRA believes that Lithia and Driveway will compound its earnings per share at an annual rate of -1% over the next 3 years. If CFRA's projection comes to pass, it would represent a material deceleration in growth for the company. Is this realistic? It depends on which side of the fence you lean toward. On one hand, CFRA states, and I quote, Lithia and Driveway will likely continue to grow through acquisition as it progresses toward its goal of $50 billion in revenue and $55 to $60 in earnings per share by 2025. We believe Lithia and Driveway has one of the industry's best management teams. The automotive retail industry is large and fragmented, which offers the potential for growth via acquisition. Lithia and Driveway has proven adept at growing EPS through accretive acquisitions and buybacks over time, unquote. Boy, $60 in earnings per share by 2025 does not sound like a material deceleration in growth at all. On the other hand, CFRA has this to say about the near-term setup. Again, and I quote, we have concerns that near-term earnings have peaked and more difficult times are ahead for auto dealers as new vehicle sales slow and interest rates rise, unquote. In this kind of situation, I really must give the benefit of the doubt to the company. Lithia and Driveway's management team has a proven track record of excellence over a very long period of time. Speaking of which, I'd like to call to attention the fact that Lithia and Driveway is a family-led business. The DeBoer family founded the company, owns more than 1% of the company, and still controls it through key management positions. Brian DeBoer is CEO, and Sidney DeBoer, the son of the original founder, is the chairman. The DeBoer family undoubtedly has every incentive to continue with its excellent stewardship of the business. While there could be some bumps in the road over the next year or two as higher interest rates and falling car prices take their toll, Lithia and Driveway has built up a tremendous organization with scale and resilience. I'd be inclined to split the difference here in terms of CFRA's near-term EPS compound annual growth rate projection and Lithia and Driveway's own demonstrated long-term EPS compound annual growth rate. And that puts us well into double-digit territory. With the payout ratio being so low, that clearly offers the company the ability to grow its dividend at a double-digit annualized rate for years to come, even in a suboptimal operating environment. Seeing as how the yield is so low, one must kind of bank on that kind of growth playing out, and I believe Lithia and Driveway will deliver over the longer term, while also acknowledging that the next 12 to 24 months could be dicey. Again, for long-term dividend growth investors who don't need immediate income, this is a premier compounder poised to continue compounding at an elevated rate. Moving over to the balance sheet, the so-so financial position is the one facet of this business that I don't love. The long-term debt-to-equity ratio is 1.1, while the interest coverage ratio is approximately 4.5. Those metrics are not impressive. Personally, I start to get uncomfortable when the interest rate coverage ratio is under 5. Also, a long-term debt load of roughly $5.5 billion on this kind of market cap is slightly concerning. I'm a huge fan of the serial acquirer method, and I own shares in many serial acquirers in my own portfolio, but most of these businesses are funding programmatic acquisitions with cash flow. In this case, Lithia and Driveway is using quite a bit of debt for that activity. The balance sheet is the one blemish for me. Profitability, however, is fairly strong. Return on equity has averaged 24.2% over the last 5 years, while net margin has averaged 3.5%. The company's returns on capital are decently high and margins are supported by the servicing side of the business. I'll also note that margin has been steadily and slowly expanding over the last decade, indicating accretion from the acquisitions. Overall, Lithia and Driveway has been a highly effective industry consolidator, building a dealership empire in the process of doing so. And with scale in a fragmented industry, localized franchise monopolies, OEM-backed inventory, and OEM-authorized warranty servicing that protects the dealership flywheel, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While every industry has competition, each dealership is supported and protected by local franchise control. Rising interest rates and falling used car prices are near-term headwinds for the business. The company's balance sheet is stretched, which may start to limit its consolidator abilities in the future. Cars are high-ticket items, and any kind of recession would almost certainly reduce demand for autos, which would harm the company's financial results. The serial acquirer method requires consistently sound capital allocation, and so Lithia and Driveway's management team must continue to be prudent and take on sensible acquisitions. While these risks are worth taking seriously, I also think the quality of this business should be taken into account. Also, the valuation appears to be very undemanding. The stock's price-earnings ratio is sitting at a lowly 7.7. Now, this is a stock that never really commands a high earnings multiple. Its own 5-year average PE ratio is 10.6. Still, we are well below that already low level. I believe the market is trying to price in near-term softness, but this may be overdoing it. The price-to-sales ratio of 0.3 is wildly pessimistic, and the yield, as noted earlier, is basically in line with its own recent historical average. I valued shares using a 2-stage dividend discount model analysis. I factored in a 10% discount rate, a 10-year dividend growth rate of 20%, and a long-term dividend growth rate of 8%. Admittedly, these are aggressive growth rates. I rarely go this high in my model, but if I've ever seen a business growth profile that deserves the expectations to be cranked up, it's this one. Lithia and Driveway has been growing its business at well over 20% for a decade straight, and the last 2 dividend raises were in the 20% area. Despite the large dividend raises, the payout ratio is still only at a mid-single digit level, one of the lowest payout ratios that I know of. As I noted earlier, if we split the difference between CFRA's near-term earnings per share growth forecast and the company's own 10-year earnings per share compound annual growth rate, we're at a mid-teens growth rate over the next several years. Thus, growing the dividend at 20% annually for 10 years under those conditions would only require a modest expansion in the payout ratio. The only way Lithia and Driveway doesn't deliver double-digit dividend growth over the next decade is if the business almost completely collapses, and I don't see that happening. The dividend discount model analysis gives me a fair value of $291.11. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates LAD as a 4-star stock with a fair value estimate of $500. CFRE rates LAD as a 3-star hold with a 12-month target price of $255. A decently wide range here, averaging the three numbers out, gives us a final valuation of $348.70, which would indicate the stock is possibly 17% undervalued. Here's the bottom line, guys. Lithia & Driveway has built itself an automotive dealership empire after effectively consolidating its fragmented industry through sound acquisitions. The business model has powerful built-in competitive advantages that lock customers into its flywheel. With a reasonable yield, double-digit dividend growth, and extremely low payout ratio, nearly 15 consecutive years of dividend increases, and the potential that shares are 17% undervalued, long-term dividend growth investors ought to take a good look at this family-led serial acquirer. And now for a special news announcement. Fastenal Company, stock ticker FAST, just did it again. The company increased its dividend by 11.4%. This is the 25th consecutive year in a row in which the Fastener Company has increased its dividend, setting it up to become a dividend aristocrat. This has been and remains one of the most consistent, reliable dividend growers out there. It's truly one of my favorite businesses. Almost can't own too much of it. If you don't yet have shares, I'd recommend to consider changing that, taking a good look at Fastenal right now. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check out the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.